In this video, I'm going to talk you through one of the most important principles for accounting in your business. I will explain what it all means and why it's important. If you haven't subscribed yet, do make sure that you hit that subscribe button so you are notified next time a video is uploaded about all things business and money. I am Annette Ferguson, Chartered Accountant and Certified Profit First Professional, and I run Annette Co, a UK-based accounting firm. The accounting equation lies at the heart of everything in your business's financials. Those reports that you get, your balance sheet, your profit and loss account, as well as your business's bookkeeping. The key basic behind the accounting equation is that the value of things that your business owns is equal to the value of things that your business owes. These always have to equal each other. They cannot be different. It is not possible in accounting for them to be different. So this is a key thing that you need to understand about the accounting equation. The value of things that the business owns is always equal to the value of things that the business owes. And I understand when you first hear that sounds confusing. You think, well, that's not possibly true. Surely one is outweighed by the other. But I'm going to explain to you exactly how it is true and exactly how it works in practice in your business. So hold tight. Assets is the word that we use to describe the value of things that the business owns. The value of things that the business owes, there are two words to describe that, depending on who it owes it to. So if the business owes to a third party, then that is called liabilities. If the business owes to the shareholders, business owner, then that is called equity. So two words for the value of things that the business owes: equity and liabilities. Let's say that your business has taken a 10K loan from the bank. What happens is that money is deposited in the business bank account. That £10,000 is money that the business owns. It's money that the business has, and therefore it is an asset. That cash that you've received is an asset. On the other side of that, the money, the £10,000, is also owed. It's money owed back to the bank at some point. So it is also a liability. So you've got your £10,000 asset equaling your £10,000 liability in your business. You can see that they match each other. The value of the thing that the business owns is equal to the value of the thing that the business owes. And this is core too, that each transaction has two sides to it. That forms the basis for what we call double entry bookkeeping. Now, I will do a video as well on double entry bookkeeping, and once that's done, we'll put the description in the notes to this video as well for you. But back to our assets, liabilities, and equity. So in the example, we can see that the £10,000 cash asset is equal to the 10,000 liability back to the bank. They equal each other. We can see that the value of things owned is equal to the value of things owed. So having explained that the value of things owned, assets, is equal to the value of things owed, liabilities, and equity, we can now put together the accounting equation, which is assets equals liabilities plus equity. Namely, the value of things owned equals the value of things owed. So assets can include things like cash, plant and machinery, land and buildings, equipment, computer equipment. It can also include money that is owed to the business, which can often be called trade debtors or accounts receivable. Liabilities include things like money that you may owe suppliers, also called trade creditors or accounts payable, taxes owed, wages owed, pension payments owed are all included in liabilities, as well as, like we saw in the example, loan money that is owed to the bank or anyone else that you have a loan from. The most common types of equity are shareholders or owner's equity and retained earnings. I will do another video on retained earnings and we'll go much deeper into that. Once I do record that, we'll make sure we include it in the notes to this video so you can check that out if you're interested in learning more about retained earnings as well. But for now, we'll speak about retained earnings as the historic profit in the business retained for future use. We know now that our equation is assets equals liabilities plus equity. So we have our 10K of cash asset equaling our 10K of liability to the bank, our accounting equation. If this video is helping, supporting, and resonating with you, do remember and hit that like button. A balance sheet is what we use in business to display the assets, liabilities, and equity of the business. The balance sheet is drawn up as at a point in time. It is at one point in time showing the value of all those things, and therefore it's commonly described as a snapshot of the business's position at a particular date. The balance sheet is one of the most important financial reports for a business, but it is also one that is most often overlooked by small business owners, mainly because most small business owners don't really understand what they are looking at when they are looking at a balance sheet. So hopefully for you, this video is turning that around. But you can tell a lot about a business from its balance sheet, including whether or not the business is actually solvent. So let's now look at some more examples of the accounting equation so you can understand how transactions that you see every day in your business plug into this and therefore understand more when you are looking at the balance sheet for your business. So with the £10,000 bank loan that we have, I've decided that I'm going to buy a new computer and it will cost £2,000. So I will take £2,000 cash from my business and I will spend it on my new computer. In this instance, the new computer has a useful life in the business of a few years, hopefully, and therefore this is deemed to be an asset of the business, which means that when I spend my money on my new computer, I reduce assets by £2,000 because the cash has left my bank, but then I also have the £2,000 computer going into assets. So at the end of that transaction, my total value of assets still equals £10,000 and my liabilities haven't changed. So my accounting equation still has 10,000 of assets, which is now split between 8,000 cash and 8,000 computer equipment, equaling my 10,000 liability. I've now decided that I need to spend £20 on stationery in my business. So I spend the £20. That means my cash, my assets has decreased by £20. And the other side of that, remember there are two sides to our transactions, is in the profit and loss account, which for the purposes of this therefore means it is in the retained earnings side of the accounting equation. So that means that my assets are now 9980, my £10,000 worth of assets minus my £20. And on the other side of the equation, my liabilities are still my £10,000 owed to the bank, and my retained earnings now has a negative balance. It's now negative £20, which means my liabilities and equity added together equal my 9980 i.e. my assets and my liabilities plus equity still equal each other. So next, we've made a sale in our business and we've sold our services for £500 and our client has paid us that money. So what happens here is that our bank balance is increased by £500, i.e. our equity is increased by £500, and the other side of that goes into retained earnings. It goes into our profit and loss account. So in this example, it goes into our retained earnings, our equity balance, which means that we now have the accounting equation as assets of £10,480. That is made up of our £2,000 computer plus £8,480 in cash. And that equals our liabilities, which is £10,000 to the bank plus £480, which is our sale of 500 less our stationary purchase of 20. We are still in balance always with the accounting equation. Both sides equal each other. They have to. If they don't, something has gone terribly wrong. For most pieces of accounting software, it's not possible for that not to happen. It wouldn't work. It just wouldn't be able to function if you have both sides not equaling each other. So they always equal each other. So to recap, we've learned that the value of things that our business owns is always equal to the value of things that our business owes. This is the accounting equation mapped out. It is assets equals liabilities plus equity. And it always has to balance. That gets pulled into what is our balance sheet. And our balance sheet is a summary of that position for our business at a snapshot in time. Now, if you are struggling to understand the accounting things for your business, do make sure that you reach out. You can drop me an email at yt@annetteco.co.uk and let me know how I can help. Be sure to like this video if you enjoyed it, and remember to hit the subscribe button. Thank you so much for watching, and I'll see you in the next video.